This is what the finance industry wants investing to look like: screens, jargon, urgency, noise. Complexity is profitable. For them, confused people pay fees, chase tips, and panic at exactly the wrong moments. Here's what investing actually requires. On one whiteboard, buy a small slice of the entire economy. Keep buying it automatically for decades. Ignore everything else. That's it. That's the secret the noise machine buries. But trust me isn't good enough. So today I'm going to prove it to you. What a stock really is, why the market goes up over time, the one product that made cheap investing possible, the accounts that legally cut your taxes, exactly how to start this week with any amount, a real walkthrough of your first $1,000, the 3 mistakes that destroy more wealth than any market crash, and at the end, honest answers to the objections you're already thinking. What about crypto? What about real estate? Isn't this whole thing rigged? This is the video I wish someone had shown me at 18. Let's earn that title. Part 1. Forget the flashing charts. A stock is a piece of a real business. When you own a share of a company, you own a tiny slice of everything it is: its factories, its brands, its profits. You make money 2 ways. The company pays out part of its profit to owners. That's a dividend. Or the company grows more valuable over time and your slice grows with it. That's it. Every chart you've ever seen is just people arguing minute to minute about what those slices are worth. And this is the mental switch that separates investors from gamblers. Gamblers buy tickers and hope the squiggle goes up. Investors buy businesses and let them work. When you hold a slice of a great company, thousands of employees walk into work every morning. For you, the squiggle is noise. The business is the thing. Part 2, the question every beginner secretly has. But doesn't the market crash? Yes, regularly. And here's the century-long view they never show you on the news. Zoomed in, crashes look like the end of the world. 1929, the dot-com bust. 2008, the pandemic. Zoomed out, every single one of them so far has been a temporary wrinkle on a rising line. The U.S. market's long-run average return has been roughly 10% a year, including every crash on that chart. Why does it rise? Not magic, arithmetic. The market tracks business profits, and profits grow because populations grow, productivity improves, and millions of companies wake up every day trying to earn more than last year. Betting on the market long-term isn't gambling on a squiggle. It's betting that human beings will keep inventing, building, and selling things. That bet has paid for over a century. One honest caveat: because this channel doesn't sell fairy tales, past performance guarantees nothing, and any 10-year stretch can disappoint. Which is exactly why the plan you'll hear today only uses money you won't need for years, and why time in the market is the entire trick. Almost every long holding period in U.S. history has ended positive. The market's history says patience gets paid. Part 3. So you should own businesses, but which ones? Picking winners is brutally hard. Most professional fund managers with teams and terminals fail to beat the market average over the long run. We'll do a full video on that scandal tomorrow. Enter the greatest invention in the history of personal finance: the index fund. One share of an index fund buys you a slice of every major company at once. An S&P 500 fund holds around 500 of America's biggest businesses. A total world fund holds thousands across every continent. You stop trying to find the needle, you buy the entire haystack. Diversification. This broad means no single company's disaster can sink you. If one company dies, it falls out of the index and gets replaced. The basket is self-cleaning. You never have to be right about any individual stock ever again. And the fees, pay attention, because this is where fortunes quietly leak. A typical actively managed fund charges around 1% a year. Good index funds charge as little as 0.03%. Sounds trivial. Over an investing lifetime, that 1% difference can consume a quarter or more of your final wealth. Same market, same returns. The only difference is who keeps the money, you or the person in the nice suit. Part 4, the engine that makes all this worth doing, compounding. Your money earns returns. Those returns start earning their own returns. Then those earn returns. Growth on growth on growth, accelerating quietly for decades. Numbers, because numbers convert skeptics. $300 a month at historical average returns. After 10 years, you've put in $36,000 and the pile is around 60. After 20 years, you've put in $72,000. The pile is roughly 220. After 30 years, you've contributed $108,000. And the pile is somewhere near $650,000. More than 80% of it is growth, money your money made. See the shape of that curve? Slow, 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 sudden. That's why starting now beats starting rich, and why the 25-year-old investing 200 beats the 35-year-old investing 400. In compounding, time is the expensive ingredient. Money is the cheap one. Part 5. Where the money goes, because governments quietly offer you deals most people never claim. Chest 1, the employer retirement plan, the 401k or its cousins. Money goes in before tax, grows untaxed for decades. And the headline, many employers match your contribution up to a limit. That match is an instant, guaranteed 100% return. It is the single best deal in all of finance, and people skip it every day. Chest 2, the Roth IRA. You pay tax on the money now, then it grows completely tax-free and comes out tax-free in retirement. Decades of compounding that the tax office never touches again. For young people in lower tax brackets, it's borderline unfair, in your favor for once. Chest 3, the regular brokerage account. No special tax breaks, but no rules either. This is for money beyond the limits, or goals before retirement age. The order engraved in stone: 1. Contribute enough at work to capture every drop of the match. 2. Fill the Roth IRA toward its annual limit. 3. Go back and raise the 401k percentage. 4. Overflow into the brokerage. And inside every one of these accounts, the same boring, beautiful index funds from Part 3. The account is the wrapper, the fund is the food. Contribution limits change over the years, so check the current numbers. Link in the description. Part 6, exactly how to start this week in 4 steps. And step 4 will sound like a joke, but it's the most important one. Step 1, open an account at a major low-cost brokerage. The big reputable ones all offer zero commission trades and no minimums now. The differences at beginner level are cosmetic. This takes 15 minutes and a driver's license. If you have a workplace plan with a match that's already running, this is your Roth IRA or brokerage from Part 5. Step 2, pick one fund, a total market or S&P 500 index fund with an expense ratio under 0.1%. 1. Not 7 funds, not a starter portfolio, one broad, boring basket. You can add international exposure later. What matters now is that the machine starts. Step 3, automate the buy. Same day every month, money moves in and buys automatically, $50 or $500, whatever your machine allows. This is dollar cost averaging. You'll buy some months high, some months low, and never have to be smart about timing ever again. Step 4, delete the app from your phone. I'm serious. Checking daily is how beginners turn a 30-year plan into a panicked sale during the first dip. The account needs your attention roughly twice a year. The less you look, the richer you get. There's real research on that, and it's the punchline of the whole video. This is the only game where the laziest players win. Now let's make it real, because abstractions don't build confidence, walkthroughs do. Here's your first $1,000, step by step on any major brokerage. The screens differ slightly. The moves don't. The money arrives from your linked bank account. That transfer takes a day or two the first time. You search for your chosen fund, a total market or S&P 500 index fund. The description will say expense ratio, and you want that number tiny. Think 3 to 0.05%. You choose buy, you enter the dollar amount. Most brokerages now sell fractional shares, so you can invest exactly $950 without worrying about share prices. You select a market order, you confirm, and that's it. No bells, no confetti. A confirmation screen so boring you'll wonder if you did it right. You did. 2 first-timer notes. 1. The price will wobble the very first week, and your brain will scream that you picked the wrong moment. You now know that voice and its name. Ignore it. The plan is 30 years, not 30 days. 2. Notice what you did not need. No charts, no timing, no hot tip, no 12-tab research spiral. The entire skill was transfer, search, buy, leave. Congratulations, you're an owner now. Set up the automatic monthly repeat before you log out. Then do step 4 and delete the app. Before the objection round, the 3 mistakes that hurt beginners more than any crash ever will. All 3 will tempt you within your first year. Count on it. Killer 1. Waiting for the perfect moment. It's at an all-time high. I'll wait for the dip. The market spends a surprising amount of its life at or near all-time highs. That's what a rising line does. The dip waiters of every decade are still waiting. Time in the market beats timing the market. It's a cliche because it's arithmetic. Killer 2. Betting serious money on single stocks or hot trends because a video said it's the next big thing. If you want a gambling budget, 5% of your investments, money you can smile about losing, fine, you're human. But the foundation stays boring. The moment exciting and retirement live in the same account, you've left investing and entered the casino. Killer 3, the big one, panic selling. Your account will drop 20-30% at some point. That day, selling will feel like wisdom and holding will feel like denial. Remember the zoomed out chart. Every investor who got rich in index funds has one thing in common. They were unremarkable enough to just not sell. Print that if you have to. Now the objections, fair answers, no straw men. Objection 1. Why not crypto? It grew faster. Sometimes, yes, with crashes of 80% along the way and no underlying business producing profits. Crypto is a speculation on adoption, not ownership of earnings. Verdict. If it fascinates you, it lives in the 5% fund budget, never the foundation. Objection 2. Gold is safer. Gold is a shiny rock that produces nothing. No profits, no dividends, no employees showing up for you. It's held its value across centuries, and over long stretches it has badly lagged owning actual businesses. Verdict. An insurance blanket some people like, not an engine. Objection 3. Real estate is the real wealth builder. Real estate is a legitimate second path, but the version people imagine skips the tenants, the roofs, the vacancies, and the fact that it's a part-time job with a mortgage attached. Index funds need 20 minutes a year. Verdict. Fine later as a deliberate business decision, not instead of the machine, and never before the emergency fund. Objection 4. The deep one. Isn't the market rigged for the big players? Here's the honest answer. For traders, the big players do have real edges: speed, information, infrastructure. You cannot beat them at their game. But you're not playing their game. You're buying the whole economy and holding for decades, a game where their edges don't matter and your patience does. The index fund was literally invented so ordinary people could stop competing with Wall Street and just own it. Rigged for insiders at the minute-to-minute level? Somewhat. At the 30-year level? The rigging is called compounding, and it's on your side. One more building block before the killers, because you'll hear the word constantly. Bonds. 90 seconds, everything a beginner needs. A bond is a loan you make to a government or a company. that pays you interest and returns your money at the end. Where a stock makes you an owner, a bond makes you the lender. Lenders get smaller rewards, but steadier ones. Bonds historically return far less than stocks, but they don't crash by half when the market panics. Usually they wobble gently, which is the entire point. Bonds are not an engine, they're a stabilizer. So, do you need them at 25? Mostly no, and this surprises people. With decades of runway, crashes are purchase opportunities, remember, and every dollar sitting in the stabilizer is a dollar off the engine for 30 years. That's expensive calm you don't need yet. The classic guidance: bonds earn their seat as you approach the years you'll actually spend the money, gradually shifting from roughly nothing in your 20s and 30s toward a meaningful cushion near retirement when a badly timed crash could hit a portfolio you're about to draw from. You met that idea as sequence risk, and if managing that gradual shift sounds like a chore, the industry built an autopilot, the target date fund. One fund labeled with your retirement year that starts stock heavy and glides toward bonds automatically as the date approaches. Slightly higher fees than raw index funds, radically better than getting the mix wrong or never starting. For a workplace 401k especially, the target date fund is often the one decision correct answer. That's bonds. Engine now, stabilizer later, autopilot available. Back to the trap doors. The whole game on one board. A stock is a business. The market rises because profits grow. Index funds let you own all of it for near zero fees. Compounding turns time into the heavy lifting. Accounts in order, match, Roth, more 401k, brokerage. 4 steps this week, and now you've even seen the first $1,000 placed, click by click. Dodge the 3 killers and you have honest answers for the crypto guy at the barbecue. You now know more practical investing than most people who talk about it at parties, and everything else you'll ever hear is either detail or noise designed to make you trade. One claim from today deserves its own trial. I said most professional fund managers lose to the boring index. That's an outrageous claim about people paid millions to pick stocks. And tomorrow, I put up the evidence. Why the S&P 500 quietly beats around 92% of the pros, what happens inside the index machine, and the honest catches nobody mentions. Subscribe. The case files are already on my desk.